Good afternoon, everyone. Welcome to today's quick start training for Thursday, January 5th. Happy New Year to everyone. Hope all your holidays were lovely. Got to spend some time with the family, had some delicious food. Seems pretty common across the holidays. Just to make sure everyone can hear the sound of my voice, please type a 1 into the questions box. All right, excellent. Looks like I'm coming through loud and clear. We do have our disclaimer up. I do suggest everyone review it, basically saying, since we're looking at markets after the fact, these are hypothetical. We're simply pointing out where the indicators agree with our rule set, specifically to point out these trade setups. And the goal of our quick start training is to cover the basic setups. So hopefully we'll get to look through each of them over the course of these 2 days. We're also here to answer any questions you may have, so feel free to throw some questions at me in the questions box. We do want to make sure that everyone understands the rules, how to use the indicators to spot these trades, also how to watch out for choppy market conditions, looking for ideal times to when we should sit out, when are better times to trade, and all kinds of little tips and tricks to help get you on the fast track using Pro9Trader. If you would like to take a look at a particular trade setup, just holler at me the market and time in Eastern time. That's what my charts are set to, and that'll be the easiest way for me to find that for you. All right, so I think this has been up long enough, and we can jump right into it. So first, before we get too far, I would like to bring up something very important. I do try to point this out every time, is news. We should definitely be aware of the news. It's a good idea to check it out maybe the night before or the morning if you get up a little early and you're up before the markets are open. It's good to know what time news is coming. We're specifically concerned with any news that has a black, red, or green dot next to it. And we set out 5 minutes before and 5 minutes after these particular news events. We found looking back historically, we found a higher frequency of qualified losing trades that happened during that 10-minute window surrounding news. So we found that it's better to just sit out during that time than take what might be a qualified trade but ends up going against us, because we do want to minimize our losses as much as possible. Philip S., good to see you in the room, asks, is this info reflected in trading and the smart money room? Yeah, and I'm not sure. I don't get a chance often to check out the smart money room, as it happens when I'm working, but I do know he follows the Pro9Trader rules. I'm not sure how in-depth he gets into discussing each of the setups, as it is a bit different managing a live room and actually looking for trades than kind of going over the training of it and teaching the basics of how we can use the indicators to spot the trades. So I do know he does delve into a bit of training, when the markets are slow and stuff like that. All right, so and something particular about today, a few things about this news is we have our natural gas and petroleum status report. Petroleum is usually on Wednesdays, but usually when there's holidays, they push it back a day. So petroleum news, we're really only concerned with that and the CL. And the same with this natural gas report. If you trade NG, which that's not really one of the markets we look at, so we're not really concerned with that either. I would like to point out we do have this 9:45 and 10 a.m. news that we are concerned about. So if we're not looking to trade 5 minutes before and 5 minutes after news, we'd be sitting out from 9:40 to 9:50 for this news event, and then from 9:55 to 10:05. So there's this little 5-minute window where we can look to enter new trades. But I feel that we shouldn't be trying to jump into a trade in that small window, because we're going to have another news event. So over that whole period, so I can apologize about that. All right, so over that whole period, maybe a good idea just to sit on our hands for that period, as back-to-back news events can be a little unpredictable. I don't think it's that great of an idea to try to hop in as many trades as, just because there's an opportunity to trade doesn't always mean it's the best opportunity. And that's really what we're trying to do with these indicators, is find the best opportunities to enter the most highly qualified trades. So I just want to point that out before we get started too far. So let's take a look. So right off the bat, it doesn't look like we have anything going on in the TF. As you can see, our EMAs aren't really in any order for us to be looking at for a trade. It's like there's a trend reversal from this morning. So not too much going on. And during these times, you just kind of sit back and either check out other markets or just wait. And that's really something I like to stress, is we don't want to overtrade, right? So we don't want to try to enter into a bunch of trades just because we have a good feeling about them, or they look good. We want to stick to the rules to a T, as the rules are there for a reason, because during the creation of this program, the continuation setup may have been something, I'm not sure on the very first iteration of the rules, but just as an example, it may have just been the EMAs and the super trends and then the turn bar. And then adding this direction histogram and checking back, we see that if we wait for this indicator to confirm, we can avoid a huge number of losing trades. So I'm not sure what that number is. I think Todd said it something 50 to 60, maybe 70%, something like that. But anyhow, so the rules are there for a reason. As we continue to watch the TF, now we do have a qualified momentum trade here soon after the market opens. So I know some people aren't too eager to trade right after market opens. I don't mind. I even try to catch trades right at the opening bell, which is possible. And if I see an example, we'll go over that as well. So let's get my rules for the momentum trade. So the momentum trade is probably the easiest to qualify, possibly the most numerous trade we have. Let's check it out. So we need our EMAs in the correct order, which for the momentum, we're only looking for the 10, 20, and 50 EMA to be in the correct order. So we have our 10, which is the small, very tiny white dots. Above that, the slightly larger square dots, that would be the 20, and these longer dashes are the 50 EMA. So we can see here that we're looking to go short, so we want the 10 on bottom, 20 above that, and the 50 above that. We don't really care about the 200 for this trade unless we're going to run into it. And you can think of this as a universal rule. If you're entering into a trade and you do not have enough space to hit your profit target before running into the 200, we're not going to enter that trade. And enough space is our profit target plus a tick. So in the case of a momentum trade, our profit target is 6 ticks. We would need at least 7 ticks of space before hitting the 200 to enter into that trade. And the reason for this is the 200 can act as a very strong place of support or resistance. So you can never really know when you're going to, or when the price is going to move through the 200. So we just avoid that situation altogether. Now we do have similar rules for the high and low of the day, although we can disregard those in certain instances. So we do have our EMAs in the correct order. We're also looking for our blue line to be below the histogram, or this purple line. This purple line is on the edge of the histogram, and that's actually what defines its value. So that's the value we're concerned with. So really the simplest way to think about this rule is if you're looking to go short, the blue line needs to be below the pink line, pink-purple. And if you're going long, the blue line needs to be above. All right, and if you have the newest update, Pro9Trader version 5, you may have noticed that the colored background doesn't happen as often as it used to. Where the colored background would previously tell us when the 10, 20, and 50 EMAs are in the correct order. So the background's red when they're in the correct order for a short trade. The background's green when they're in the correct order for a long trade. Now, the colored background also considers the blue line. So even if these EMAs are in the correct order, if the blue line is not on the correct side of the histogram, the colored background will appear, I think the default is gray, or it may appear black on your screen. So this lets us know, it basically qualifies 2 rules for us. So we can see how easily it is qualified. As we have a red background, we're looking to go short, and we have our momentum arrow. So that's a qualified momentum trade, and that's just how simple it is to qualify it. And our entry price would be the DPI that creates the bar that has the momentum arrow above it. We check when looking back historically, we check the bar before, and I'll go over the DPI in a second. So our entry price would be 1382.2, which would be the price needed to be reached to close this bar. And we'd enter this trade with a 6-tick profit target. We'd use 3 contracts, a 15-tick stop, and a 6-tick profit target. And I think this one, so this actually would go against us, as this turn bar would travel more than 15 ticks and stop us out. So this is going to happen sometimes. I don't want to shy away from losing trades or pretend they're not going to happen. Sometimes the first trade we take during the day is a losing trade. But, and this is something I like to stress as well, it's likely one of the hardest parts about trading is the psychological and emotional aspect, because we all know when money is involved, our emotions are closely linked to it, and especially with trading. So that's one of the hardest parts, but you can also train yourself to move past it, because we don't want to let one losing trade throw off the whole day, because we could miss out on other trades that could be extremely profitable and make up for that loss and even go further and produce profits. So this is why I actually like seeing examples like this, and I like debriefs like this, because it shows that even if you start the day off rough, you can easily recover and turn it into a profitable day. But the flip side of that is that I've also seen is someone encounters a losing trade right off the bat, and it throws off their day, and then they're, it's not working or whatever they think, and so they'll sit out for a few trades and wait to wait to see a few winning trades without entering them, which I think is a little odd. I would like to try to get into the most ideal trades, and obviously we don't know if those are going to be successful ahead of time, but they do have a higher likelihood to. And then after they see a few winning trades, they decide to hop back in the market, and they decide to hop back in on a trade that goes against them again, resulting in double losses, no profits in between there to help make up for the initial loss. So it's something to be wary of, is that we are going to take losing trades. Everyone's going to, no one's immune from it. It's part of trading. So no system is 100%. But we also, it helps me to think about it over the long term. Because if we look from day to day, or just from hour to hour, or however, if you look on a very short time scale, it can impact us mentally in a much different way than if we think of this as a longer term strategy. It's a very kind of slow and steady wins the race. And I like Todd's analogy, is that we're like snipers. You know, a sniper will sit in the hills a mile away, camouflaged for 3 days waiting for the perfect shot. Now, of course, we're not going to wait 3 days for a trade, but the point stands is that we don't want to try to jump into too many. But, so, anyhow, before I get too far off track, this one did go against us, and then the next ones are heading right up to news. So, won't be able to hop into these until after 10:05. So, and this is another thing about the 9:45 and 10 a.m. news. I know when that happens, some members just like to sit out until after the 10:05 news, which may be a good idea, and we just have to be prepared that some days when we do that, we're going to miss out on winning trades. So there's no perfect way to avoid that. So I would like to cover the DPI first before we get too far in. It's a very important indicator, and understanding it can help us anticipate the trades farther ahead of time, because ideally, and when these situations present themselves, we want to be able to enter our order in as far ahead of time as possible. And we use stop limit orders so that we can, once we see a qualified trade situation, we can put it in, and it won't be filled until it hits that price. So this is our DPI indicator over here, these green and red numbers, which are just prices on the market. But these particular prices let us know when a new bar will be created. We don't know which bar it will be, but we do know that in this case, if the price reaches 1371.6, it will plot a green color bar since we're currently trending long. If it reaches this 1369 even, it will create a turn bar. And this takes 4 ticks in the direction of the trend to plot a new color bar, and 22 ticks in the opposite direction to plot a turn bar. So understanding this can really help us anticipate these trade setups, because of course we can't know what type of bar it's going to be ahead of time, but we do know what price needs to be reached for it to create one of the two options. And knowing that lets us have extra confidence in putting in our stop limit orders ahead of time and able to anticipate them so we can be in ahead of everyone else. So these were during news. We can see quite a bit of chop during news, or these very short cycles, so not too much. That's looking good. Not much here, so let's see if I can point out how we can anticipate these trades. You may have noticed these yellow turn bars as well. The most simple way to think about these is that if the bar is yellow, your super trend rule is not qualified. So it is not going to be a qualified trade. So here, and I like to keep a running tally of what rules are qualified as the market continues to move. That lets me know if I should continue to really look at this market for a trade setup, or if there's nothing going on, and there may not be for a while, and I should maybe check out some other markets. So in this situation, I have 3 EMAs in the correct order, the 10, 20, and 50. So this, off the bat, I know that I'm either going to, or it's possible, I could see a momentum short on the horizon, as I only need the 10, 20, and 50, or it could be a continuation, as I only need the 10, 20, and 50 to be in the correct order for that trade as well. And both of these require the blue line to be on the correct side of the histogram, or to be less than the histogram value, and the blue line is on the correct side at this time. Our super trend is almost outside of its neutral zone. Let's see, it's pretty close, and we may be able to disregard that. Depending on the trade, the momentum doesn't even look for the super trend. So right here, I'm looking pretty decent for a possible trade setup. So I would be pretty interested as this market continues to develop. So here we did have a green color bar. And my blue line did jump up to the other side of the histogram, so I don't have anything just yet, but I can anticipate that if this next bar is a turn bar, the blue line is likely to cut back through to the correct side. Now, we won't always be able to tell that, and I do like to stress that if you're not sure, wait. And really the only time you're going to be sure is when it's very close to the purple line. So in this case, I still have my 10, 20, and 50 in the correct order. I'm confident that if the next bar is a turn bar, that this blue line will cross to the other side of the histogram. My super trend is not outside of its neutral zone. It may be if this bar right here closes. Let's just do this, see what I'm talking about. If this turns out to be a turn bar, it may jump out, but I would also like to point out we have a rule for that. If you check under our super trend rule, it says not required if turn bar or first color bar has touched the 50 EMA. So this green color bar almost touches the 50, and while this bar over here is painting, it's likely to have crossed the 50. Either way, even if it goes another green bar or if it turns into a colored bar. What I would be concerned about is running into the 200, so I'd want to make sure my DPI is past the 200. So my DPI is 1380.2, and the 200 is at 1380.7. So I'm 5 ticks clear of the 200 in the direction that I want. So I'd feel not too concerned about the 200 in this case. So at this point, now notice I have the only rules I have qualified. I have my EMAs in the correct order. My blue line is not currently on the correct side, but I'm very confident that it will jump across. I'm anticipating that it will cross, as it's very close to the purple line anyhow. My super trend is not outside of the neutral zone, but I can disregard that because my turn bar, or whatever this is, during this painting has crossed the 50 EMA. And then I'm waiting for a turn bar. Now, of course I don't know it's going to be a turn bar, but I do know at what price a turn bar will be created, and that'll be the red DPI at 1380.2. So if I put in a stop limit order at 1380.2, I'm expecting a few things to happen when that price is hit. Well, one, I know it's going to turn into a turn bar, so my fourth rule is going to qualify. at the same time my order would be filled. In this case, I'm extremely confident that the blue line is just going to jump right back out if we get a turn bar. So when that bar closes, the blue line will also qualify. And then my EMAs were qualified already, and I can disregard the super trend for that trade. So even though this looks like there's not a trade set up, we can anticipate by using the DPI what will happen when we hit our entry price. So, and this is one of those situations, an ideal situation where we can anticipate the setup. So it's not always going to happen like that, and we'll probably see that a few times where you may need to wait for the blue line. You may need to wait for the first color bar to close to check out the blue, or to confirm if the blue line gets to the correct side. But we'll cross that bridge as we come to it. So this bar did turn into a turn bar as we anticipated. So if we were confident in our assessment, we would be filled at the close of this bar. And now we can cover a bit of our money management strategy. And we'll walk through this trade in its entirety. So we'll enter this, as we do with all of our trades, with 3 contracts, looking for an 8-tick profit target, and our initial stop is 22 ticks. After the first color bar plots, we're halfway to our profit target. We've moved 4 ticks. So when this happens, we can adjust the stop on all 3 contracts from 22 to 18 ticks. So since the trade moved 4 ticks in our favor, we're going to move our stop up 4 ticks. Helps mitigate some of the loss if the trade should turn against us. And since we only need 4 more ticks to hit our profit target. And the second color bar plots, so this is another 4 ticks, because remember, it takes 4 ticks in the direction of the trend to plot a color bar. So here we have reached our profit target, so we're going to sell 2 of our contracts at the 8-tick profit target. And our third contract, we are going to adjust to the stop to break even. It doesn't have a profit target. We're going to adjust the stop to our entry price, which is break even, meaning we can't lose any money on this contract. It is a free trade. So there's no more risk involved in this trade. After the next color bar plots, we're not going to do anything. And once the bar 5 plots, we're going to start trailing at the high of this bar, or the high of the most recently completed bar, or high of the previous bar, whichever way you want to look at it or helps you understand better. And then at this point, we're going to continue trailing at the high of the previous bar until we get to bar 7. And at this point, we're going to widen the stop to the green DPI. You'll use whichever direction the market is moving, you'll use the opposite DPI as the stop, because you couldn't actually put a stop in ahead of the market. So in this case, we would widen it to the green DPI. Now this does give up a few ticks that we've already quote unquote secured with this runner, but this does have significant benefits, and we'll cover those as we watch the rest of this run unfold. I'm not sure how far this one goes on, and each new bar that plots, we're basically going to be adjusting our stop down 4 ticks. And as you can see, as each new bar plots, we're just going to adjust the stop on this runner, and it lets us take part in this entire run. And as you see, there's no wicks on this run, but if there were, our stop at the DPI would let us ride over all of those. And we're only going to get stopped out by a turn bar, because that would be created if the price reached the green DPI on any of these bars. So I would like to point out, if we missed this entry opportunity, we can anticipate another one. So I missed here. Dog was tugging at my pant leg or something. Wasn't paying attention. Spilled coffee, whatever the reason. I wasn't able to enter in here, but now we can attempt for a breakout trade. And the reason we can kind of anticipate this trade as well is because one of the main criteria is that we're running into the high or low of the day. So this is the current low of the day, and we are running in there, or running into it. Not quite yet, but it looks like we're going to if the price continues to move short. So that's our first clue that we have a breakout on the horizon. And then next we're looking for our direction histogram to be outside of its neutral zone, which is this gold area, or at minus 51 or below, and plus 51 or above if you're going long. So at this bar, before it's even hit the low of the day, we're already outside of our neutral zone, so that's good. And then our entry price is going to be, in this case, one tick below the low of the day. If you're going long, it's going to be one tick above the high of the day. So in this case, right here at the close of this bar 4, we can actually put in an order for our breakout as it is fully qualified. Now we're not going to use a DPI. The entry price is always going to be one tick below the low of the day if we're looking for a breakout short. So in this case, I can check my DPI, which is 1378.6, and the current low is 1378.8. So I know that bar 5 is going to close below the low of the day, but my entry price is going to be 1378.7, which is actually a tick better than if we used the DPI in this case. But we do one tick below, as even if we have a strong trend, the low of the day can act as a point of support, so we could just as easily bounce off, even if there is a really strong trend. So we enter 1378.7, and by the close of, even before this bar closes, we would enter, again using a stop limit order. Now our breakout trade is a bit different, slightly different. All of our trades follow the same general money management strategy where we enter with 3, take 2 off at our profit target, and have the third one on to catch the runner, where they break even stop initially. So, but the breakout trade has an 8-tick profit target and a 15-tick stop. And so in this case, we follow much the same strategy. Whoops. So before the close of this bar, we'd be halfway to our profit target. And before the close of this bar, we would have hit our profit target. And again, we'd be in a free trade. And we could take part in most of the run. We did miss out on the first few. But it's good to know that there are backup plans. In case we miss something, we're watching a different market at the time and just switch to this one right after this run, well, we can, you know, I hop into the market, I look at this and I say, oh, I missed the entry, but I'm pretty close to the low of the day, so maybe I can get prepared for a breakout. So, and this does come with time, you know, just practicing the rules. It is really about just memorizing the rules and pattern recognition. The more screen time you get and the more setups you see, the more ingrained they're going to get. And then eventually it'll just be, you know, second nature. And you see a continuation setup on the horizon, and you can qualify it easily. So, and we do recommend when you're first starting out, focus on the single T and continuation, as they are very similar and they're very foundational trades. As I'm sure you've noticed, a lot of the rules kind of cross over between these different trade setups. So it's a good idea to get familiar with these basic, with all these rules, and that most of our trend trades require the EMAs to be in the correct order. Most of our trades do require the blue line to be on the correct side. I think about half of them use the super trend, 3 or 4 of them, and then our entry is almost always going to be on a turn bar or the first color bar. And this will be a good time to talk about late entries since we're on this subject. So in this situation, as we pointed out earlier, this is a pretty ideal entry point. We were able to anticipate it ahead of time, put our stop limit order in ahead of time, and it was fully qualified and entered when this bar closed. So let's say, for example, the blue line crossed up a bit higher here, so we're not sure that it was going to cross out or cross back to the correct side of the histogram. So in that case, we're going to need to wait. Now we can also enter on the first color bar, no later than that. And I think the easiest way to look at that, that works for me, is the entry price of the first color bar, or the DPI that would be used to create that color bar. Those are our only 2 acceptable entry points for these trades. So as long as it qualifies by the close of this first color bar, we're good to use this entry price. We may need to attempt a retracement where we wait for the market to go back up past our original entry so we can enter using one of our entry prices. So a late entry, if the trade does not qualify until the third bar, it's actually not a qualified trade. Flat out, end of discussion, nothing more to it. So the only time we'll enter on a bar past one of these is a momentum or a breakout, because they likely won't happen on turn bars. And as far as the momentum arrows above the turn bars, they're likely to have momentum arrows above them, but we disregard those for turn bars because we do require a few more rules on these trades that we enter on turn bars. All right, and let me cover this breakout again. Something else I wanted to point out, as we had another rule here. A trade can be taken up to a maximum of 10 bars from the most recent white bar, meaning no later than bar 10. So what this means is that if the bar that breaks through the low of the day is past bar 10, that will not be a qualified breakout. It has to be, bar 10 is the latest one we can enter. Now, it says no later than bar 10. Does that mean that I can get into the trade on bar 8 or bar 10? No. And it may seem that way because you may be thinking that, oh, well, the price is just continuing to break out. Well, not really. The low of the day keeps getting it's basically just creating the new low of the day at the close of each of these bars. So a breakout is when the price moves through, I like to say, an established low of the day or current low of the day. I think it makes it a little more clear. And remember that our entry price is always 1 tick below the low of the day. So if we wait till here, well, the price is never going to retrace back to our entry price because that's way up here. So very important detail is you want to get in when the price is breaking through the low of the day. All right. Let's see what else we got. So we've covered the momentum, continuation, and breakout trade. It's not a divergence. So here there were a couple momentum trades as well. And we can cover these so we can walk through this. So again, our momentum trade, very easy to qualify. And with the new indicators, it's even easier. Basically, do I have a red background? Is the bar red? And do I have an arrow? Again, remember, because our background qualifies the EMAs and the blue line at the same time. And those are two of our rules, and the momentum arrow is the third rule. So very quick and easy to qualify. In this case, our entry would be 1369.4. We would enter this with, again, our 3 contracts with a profit target of 6 ticks and an initial stop of 15 ticks. So now we enter this trade. After this bar closes, we're more than halfway to our profit target. We only need 2 more ticks. Now, I'm not sold on the idea of adjusting from 15 to 11. I like leaving my stops where they should be, just to give me that extra wiggle room in case I do get a wick that would otherwise stop me out, where it may go, 13 or 14 ticks, and if I adjusted my stop up 4 ticks, as we do with our trades that start with a 22 tick stop, I could get stopped out unnecessarily. So, of course, there's a chance we may still get stopped out, but we were okay with that risk initially anyhow. So our entry is 1369.4. We do have this wick here, and it gets to 1370.6. So I think that's only 12 ticks. 8 ticks. So we would not get stopped out there. Something that could happen, I'd have to double check a second chart just to confirm, is when we have these wicks, since our profit target is hit usually in the middle of a bar with these momentum trades, because remember we're looking for 6 ticks, so this bar is 4 ticks, and then 2 ticks would be somewhere before this bar closes. So we could very well hit our profit target, adjust so we'd sell 2 of our contracts at our profit target of 6 ticks, adjust the stop on our runner to break even, and then this wick happens and it stops out at runner. That's okay in this case because it triggers another momentum entry, right? Although with this one, it looks like we're too close to the low, so we may have to wait for a breakout retracement. Or we could, this wick could happen first, then we could hit our profit target and continue on with this trade. So we'll just say this one gets stopped out here, and we can't enter into this one because now we're running into the low of the day. If you look, our entry price is 1 tick above the current low of the day. That's too close. We don't have enough room to hit our profit target, and our direction histogram is not outside of its neutral zone. So we can ignore entering into the low of the day if our direction histogram would qualify us for a breakout, basically. And the reason for that is we don't want to enter into a trade here that on the very next bar would be an unqualified breakout trade. So in this case, I wouldn't enter this one. I would wait to see if my direction histogram gets out of the neutral zone to see if that breakout qualifies. And I can check my red DPI is going to be 1368.2 and the low is 1368.5. So the next bar will be the bar that breaks through the low of the day. So when that closes, I can confirm if my direction histogram is outside of its neutral zone and then attempt a retracement entry. So this bar closes, come down and check. It did get outside of the neutral zone. So I would attempt for a retracement entry. If the price went back up to the original low of the day, enter at 1 tick below. And then when the price moves back down, I would be entered into this trade. And take part in the rest of the run. Um, and again, we walked through that money management strategy earlier, so we'll need to cover that again. All right, guys, we're about 45 minutes in, so we have 45 minutes left. So please feel free to holler at any questions. If you want something clarified, something we haven't covered just yet, please feel free to ask. We do want to make sure everything is covered, all your questions are answered. All right, nothing yet. That is all right. So let's take a look at CL. I want to see if, so CL didn't have a lot of action around 10:11. All right, so that was the EIA petroleum status report this morning. Not a lot going on in the CL often. What you'll see is usually when there's 10:30 news for oil, you'll see a ton of movement happen within seconds. Right at 10:30. Jennifer asks, is this recorded? I got wrong link in the emails and have only 1 hour during lunch. Yes, this is being recorded and they will be uploaded to the members area later today. We do record these for you guys. Let me show you where you can find those. If you come to the members homepage and go to resources, training room Q&A sessions, and you'll see all the past recordings. They are available for you to review at your leisure. So since this is a quick start training there, we do try to touch base and cover the same types of things. Yeah, Tripp is saying he got the wrong link too. Yeah, I think I'll check that out after class and make sure the correct one is in there for tomorrow. Do apologize about that. So it seems to be a bit of a mix-up on our end, but glad you guys can make it into the class anyhow. All right, so we do have on the horizon in the CL, we did have, let's see, this continuation here. So we did review a continuation earlier, but as we can see, now this is an instance that I was talking about earlier where it's mostly qualified, right? Except our blue line is not above the histogram. And that is definitely one of our rules, right? So we'd have to wait to confirm this rule. And by the close of the first color bar, it does indeed cut through, so we'd likely have to go for a retracement entry. And in this situation, you can even retrace to the original turn bar entry price if it happens to go down that far. All right, Gregory's asking, you mentioned ignore momentum arrows on turn bars. Can you elaborate? Yes. So what I was meaning about that is you will often see momentum arrows appear under turn bars. As we look, we have a few here looking back. So we get a lot of momentum arrows on turn bars, right? Just due to the way they're programmed and the conditions they're looking for, those are often met on turn bars as well. But our other trades that we enter on turn bars, like the continuation and single T, have a few more rules than the momentum trades. And basically we're looking also for the super trend, and in the case of a single T, we need the 200 to be in the correct order as well, unless the turn bar touches the 50, which would let us disregard the super trend as well as the 200. So since we can't filter them out, it's best to disregard them on these turn bars. So a momentum trade really happens in the middle of a run, um, and they're there to give us another opportunity to hop in when, say, the trade may not have been qualified on the turn bar or first color bar. All right, I hope that cleared it up. So again, we have this situation. We are close to the high of the day, but the direction histogram is clearly outside of its neutral zone. So we could enter that. Or if we miss this, we could also attempt for a breakout on bar 4 again. So, but I wanted to point out this right here, as this is a divergence reversal. Which is one of our, it is our only counter trend trade. So I would say it's a bit more advanced. I do want to cover it so we can start to get an idea of it. But you may want to put it on the back burner if you're just starting out. And as I said before, focus on the single T and continuation trades until you get a strong foundation of recognizing and getting in the habit of anticipating the setups so we can try to enter in as far ahead of time. This divergence reversal does have quite a bit of rules. So before I hop into that, I do got a couple of questions. John P. mentions, why is my plotting bar in the black part of the chart? Also, the EMAs do not enter into the black. I'm not sure. I'm not entirely sure what you mean, John. Let's see. Why is my plotting bar in the black part of the chart? EMAs do not enter into the black. Yeah, could you specify a bit more for me, John? I'm not sure what you're saying there. Nair, I saw your Happy New Year earlier. Happy New Year to you as well. There are changes to the software. We're going to have new videos for that, and also the alarm for the turn bar. Yeah, the turn bar alert is being worked on. There should be an update for that soon. So as far as the new indicators go, or the changes, I should say, not new indicators. If we go to the members home area, resources, essential tips, yellow turn bar, DPI, and other new features. So I'll run through those quick while we have the charts, but here's a reference place for you if you want to do some research after the class. Basically, the changes were these gold backgrounds, just to give an easier contrast to tell when the histogram is outside of its neutral zone, as it's a starker contrast than just a light blue on a dark blue. Then also you may have seen these yellow turn bars like this. And these basically tell you that your super trend rule is not qualified. So the turn bar will be yellow if the super trend is not outside of its neutral zone in the correct direction, and if the turn bar does not cross the 50. Because the turn bar touching the 50 lets us disregard the super trend. So this lets us know that the super trend rule is not qualified, period. The colored EMA backgrounds now consider the blue line being on the correct side of the histogram as well. So if our 10, 20, and 50 EMAs are in the correct order and our blue line is on the correct side of the histogram, we will get our colored background, basically qualifying two rules for you at once. And then another change you may not see too often But we do have it here is the yellow DPI. So this yellow DPI lets us know that we're going to run into the 200. As we can see, here is a perfect example. We are not clear of the 200. Our entry price is going to be somewhere in here, and we're afraid of bouncing off the 200. So, then you can think of the yellow as kind of a warning light. You should just slow down, reassess the situation, and it's likely not to be a qualified entry. So those are very briefly the changes we made, but you can review them on that page I showed you earlier. So, all right, now looking at our divergence reversal trade. So again, this is our only counter trend trade. So which seems a bit, I think it can be a bit intimidating at first, because it does seem kind of crazy when the market's going one direction and then all of a sudden you're hopping in the other direction. But very good trade setup. So the first clue that you're going to see a divergence reversal is our red dot here. If the market's trending long, it'll be a red dot. If the market's trending short, it'll be a green dot. It's the opposite color of whatever direction the market is currently trending. The green dot, or the dots, will show up somewhere in the middle of a run. It may show up on bar 5, 6, 7. It'll show up before it sticks to this turn bar. Almost always. It's very rare that you would have one that pops up on the bar before a turn bar. So this gives us a little heads up that, hey, maybe I should start looking for a divergence reversal. So that's my first clue. If I see that, and most simply, the dots are a price swing indicator, letting us know that there is a possible price swing on the horizon. And that's basically all there is to it. And if a turn bar plots and its criteria are met, it will stick to the turn bar. If it doesn't, it will move on to the next instance it's required. But even though this sounds like it repaints it, I mean it does, but it doesn't affect live trading, because you'll see it over a bar, and then if it's not qualified, it's likely that it'll just hop on to the next time it's needed. So I don't want anyone to get worried that you'll look back and see dots that weren't there. That doesn't happen. You can check back historically and check if there was a dot over the bar by scrolling over the bar and hitting F5 on your keyboard, and that'll do a brief refresh of the chart, and you'll see the dot if it was there. So in this case, we've got our first clue that a divergence reversal be rule 3, but it'll likely be one of the first things you see. The next thing I like to check that lets me know if I should be really looking into this any further is my super trend. So my super trend in this case needs to be at plus 60 or above, and that is outside of its extreme zone, which is indicated by these yellow dashed lines here. As we can see, the super trend is really pretty up there at around 75, and you can imagine the super trend as a giant rubber band or a slingshot being stretched to its limit. And then what happens to a rubber band when you stretch it too far? It snaps back in the other direction with a lot of force too. So sometimes the markets do behave in much the same way. So we have these two rules qualified. Now if I looked at my super trend and it's still down here, say I'm looking back here and I have my red dot, it popped up, and then I look and see that my super trend's really weak, I'm likely not, I might keep an eye on it, but I'm not going to be watching intently unless my super trend gets far up there. And then I know I should be looking further into this divergence reversal. And the next thing we're going to look for will be rules 1 and 5. So these kind of tie in. They're two sides of the same coin, really. So we're looking for the price bars to be plotting in the opposite direction of the blue line for at least 5 bars, no more than 10. And that's what these numbers on the blue line are telling you. They will start counting sequentially when they're plotting in the opposite direction of the price bars. So we can see here we're moving in the same direction, 1, 1, 1, 1, and this is the last one, and then starts counting sequentially. And in this case, we can see a pretty straightforward divergence on this blue line. And next we're going to be looking, we do need our blue line to be below the histogram. So you'll often have to wait for the turn bar to plot to confirm this. And that's okay, because divergence reversals we enter in using a retracement anyway. So, and we'll get to that in a second. And really, I think the easiest way to look at these rules 1, 4, and 5 is when this blue line cuts through on the turn bar, you want this number to be between 5 and 10. And that's really the simplest way to look at it. So in this case, we're at a 6, totally qualifies that rule. So now I have all 5 of these rules qualified. I do have my price bars and blue line moving in the opposite direction. My blue line made it to the correct side of the histogram. I have my red dot, my super trend is where it needs to be. So then, once all these are qualified, we have our rule 6. We did have our turn bar, but we're also going to wait for 2 color bars to plot and attempt a retracement entry. There's a very good reason for this, because even though all of this looks very good for a divergence reversal trade, sometimes the trend is so strong that we'll get 1 color bar and then it'll be another turn bar and it just turns into another continuation and takes off, which I mean would probably be okay, because you would end up taking a loss and then hopping in on a continuation, which could make up for that, but we'd want to avoid that altogether. So in this case, we're going to wait for 2 color bars to plot. We have our first color bar and then our second color bar. So once this happens, we can attempt a retracement for our original entry price of $53.90. Now, of course, and with any time you attempt a retracement entry, there's no guarantee that the market's going to travel back up far enough for us to get in. So part of the game, unfortunately. So our entry is $53.90. Let's see, did this bar, so it looks like this bar did travel up high enough for us to attempt a retracement, and then we'd manage it the same way as a continuation, where we, our 3 contracts, 8 tick profit target and 22 tick stop. And the good thing about this is we're going to enter on our entry price here, which would have reached our profit target at the close of bar 3. So when this retraces up high enough for us to get in there, we're going to get entered into our trade, and then even before this bar closes, we're probably going to hit our profit target. And then we're in our free trade, break even, and we start trailing at the high of the previous bar. And then in this case, we'd get stopped out by this wick, and we couldn't enter back in. And that's going to happen sometimes. But we were able to hit profit target and possibly grab a tick. So anytime I can at least hit profit target, I'm definitely not complaining. And I think that's one of the great things about this money management strategy, is that we're extracting an initial profit from the market and also giving ourselves as many opportunities to catch runners as possible. Is every runner going to run? No, of course not. But when it does, and we end up taking a part of it, we're going to be glad we had a contract in there, and especially a contract that's not going to lose us money. So and then not much happening in the CL. I wouldn't be able to enter this one as we're right on the 200. A bit risky. And even there was another divergence reversal, which qualifies the same way. It's kind of odd. Divergence reversals seem a bit more uncommon than the other trades, as they are counter trends. So um, it's not often you'll have all the rules line up when there's a dot. So I don't want anyone to think that just seeing a dot is good enough. And this will be a good time to go into part of the psychological aspect of trading and how people can trick themselves into thinking trades are there when they're not. So we have all these rules in place for a reason. As I mentioned earlier, they weren't just thrown together all willy-nilly just because. We found that following these rules helped us eliminate a lot of possible losing trades, so that the ones we enter are of the highest probability we've been able to find. So, and something I see that is actually fairly common is, I don't know why the dots specifically, but some people, when they get the software, for some reason the dot sticks out and they just think it's a signal to buy. And I would like to stress that under no circumstances is any single indicator we use a signal of itself. As you'll notice, all of our trades, the momentum has the least amount of rules, and it has 3 rules. So there's no signal. Or I've also heard when this dot appears and there's a cut through, when the blue line travels from one side to the other, that's a trade. And I haven't done back testing on that specifically, but I'd imagine that all these rules have been tested for quite a while, so I'm sure that was looked at initially. But this is something that happens, and it's called confirmation bias, which all humans are susceptible to, where we will look for information that confirms something I already think is true or believe. So if I just start up the software, I don't have much experience, don't really want to check out the rules, put in the work, and I just see this, and I say, oh, well, we'll move the rules off here. I say, oh, well, I see that I have a red dot and I have this blue line cut through, and those are the things that stick out at me. Say, oh, well, and look, this trade, I could have made, a couple ticks. And then, oh, I look here, I see the same thing, and I'm not even thinking about any of the other indicators or why this blue line is moving in the opposite direction. Not even considering that. And then as this continues to happen, as I continue to trade, Matt F says you got to take off. All right. Have a great New Year. Glad you could make it to the class. So as a person who notices this would continue to trade, and they keep seeing these same setups, but what's happening is your brain may ignore the situations where this isn't true, where this same setup occurred, where we had the red dot and this cut through, but it didn't succeed. And they're not really focusing on that. They're only looking for the times that confirms the setup they found. And they're not considering a larger sample size or what's happening in all the different markets. You do need quite a large sample size to determine if it's statistically going to work out in your favor, and not just watching it for a week, which is usually what happens. Though someone will send an email saying, I noticed this, and it's usually with the red dot, and then a week or two later it came back and bit them, and they say, oh, okay, I guess that's not the setup I thought it was. So one thing to be aware of, and this can have, anything, but particularly with trading, especially if there's hard days in the market or the market's slow, and I think a lot of traders want to trade. Of course it might be a bit boring if you're sitting there and nothing's happened. There's no setups, or the market's just slow, and that's going to happen too. And there's nothing we can do about it. But just because the market's slow, if it's not presenting any setups, why are we taking any setups? Because they're not there. So then we're taking pot shots in the dark. And I don't know about anyone else, but trying to shoot a gun in the dark, I'm probably not going to hit anything. So something to be aware of, because if you are aware of it, you can better combat it and kind of check yourself if this starts to happen. So all right, let's see what else we got. If anyone has any other questions or wants to, let me take a look at this run, because I do want to go into this for a bit with our trailing stop for the runner. So I'm not going to walk through the setup again. So here we have a breakout, right? This bar 10, no later than bar 10, this was the bar that broke through the low of the day. It's past the 200, we don't have to worry about that. Our direction histogram is outside of the neutral zone. And say we entered at one tick below the low of the day, as was our stated entry price. So when this bar closed, we entered with our 3 contracts, 15 tick stop, 8 tick profit target. Before the close of bar 12, we would have hit our profit target. Then we have our runner in, and somewhere, let's say after the close of bar 16, we have the option to widen to the green DPI. Now, some traders do like to just continue trailing at the high of the previous bar all the way down. And this is a great example of why I like to widen to the DPI, even though initially, you're widening it and giving back a couple ticks if you should get stopped out right away. You're not going to secure as many ticks as you had if you were trailing at the high of the previous bar initially, and that's okay, and that's another part of this mental aspect I'll jump into in a second. But one of the great benefits of widening to the DPI is that these 2 wicks here aren't going to stop us out, because the only thing that's going to stop us out if we're using the green DPI as a stop is a turn bar. So we can just ride over these and just keep adjusting our stop after new bar plots, and don't have to worry about getting stopped out unless there's a turn bar. Now, if we continue trailing at the high of the previous bar, this first wick is going to stop us out. And that's okay, because it triggers another momentum entry. That's one of the great things about a momentum entry, is if we get stopped out somewhere in the middle of a run or before we can widen to the DPI, we can likely hop back in. It's a great thing. But what if we run into a situation where I was trailing at the high of the previous bar, I secured more ticks here, I got stopped out, I have to enter back in, and then what if this wick is long enough to stop us out? Or if the next bar is a turn bar, because that's going to happen sometime. There are occasionally momentum entries before a turn bar, as we saw in our example in the TF in the very early morning. I'll show you guys real quick. But we had this momentum entry, fully qualified. The next bar is a turn bar. And this market's a little short cyclically, not exactly choppy, but these really short cycles. So the thing is, we're never going to be able to tell when the end of a trend is happening. We can't be sure when the end of a run is going to happen. So, but just as an example, I like to avoid that situation altogether, widen to the DPI, maybe give up a few ticks initially, but you're not really giving it up, because, and this helps me when I think about it this way, is that when that runner's still in there, it's not my money yet. The trade's not finished, it's still going on. I could either get stopped out when I first widen to the DPI, or it could help me take part in this run, which is a pretty good run. So that's where I think the strength of widening to the DPI comes in, is you can avoid that situation altogether, because it's going to happen statistically. It's just going to be unavoidable. And this would be also a good time to talk about lifting trades early and flattening a trade early as well. So flattening early would be when I put in a trade, I have my contracts in, I have my initial 22 tick stop, and for some reason, say I took a loss earlier in the day, I was able to make it back. I'm a little profitable now, but that little fear is talking to me and telling me like, oh, this one's going to go against me. I just know it. I know it. Well, we don't know it. Let's be honest with ourselves. We don't know what the market's going to do for sure. It could stop us out, or it could go up to 19 ticks. It could be a really high head fake and then come back down and succeed, and it could go, another runner, or we could just hit profit target, whatever the case may be. But the fact is, we don't know what it's going to do ahead of time. So if you're in that state of fear where you're worried about getting stopped out, you may lift it when it's at 10 or 12 or 15 ticks or whatever it is, and flatten the trade and say, I'm okay with taking this loss. And then you watch the trade, it goes up to 19 ticks, turns around, would have won. So we have to be okay with the risk. As this is trading, we're all subjecting ourselves to risk. There's just risk inherent in trading. We all have to be familiar. That's why they say things, don't trade with money you can't afford to lose. All the stuff like that. And our stops are, so we have to put our stops where they belong and be okay with the outcome. As over time, we've seen the win-loss ratio be more than enough to make up any 22-tick stops. So, and by flattening the trade, you will eventually cause yourself some undue stress just from taking a trade out early and taking a loss where it would have succeeded. And the stop isn't, the 22-tick stop, it does seem a bit wide at first and a little maybe risky, but it's not arbitrary at all. It's 22 ticks for a reason, and that is when Todd was first developing this. He experimented with a lot of stop settings to see which worked better, 10, 11, 12, all the way up to 32 or 33 ticks, whatever it was, the final number, and found that 22 ticks is the sweet spot where it lets us ride out a lot of head fakes that happen that shake off some traders with a tighter stop, and gives us enough wiggle room, and it's wide enough but not so wide that the risk-reward ratio is not a net gain. So even with that 22-tick stop, over time we've seen the profits more than make up for the losses. So we've seen about 4 out of 5 trades be winners, or right around 80%, give or take, during market swings and all that. Some days it's higher, some days it's lower. So, but over time we found that's the average. So we talk about flattening early, may cause you some undue stress. Lifting a trade as well, which is something I have to be honest, I do not understand at all, especially a runner. If you've already hit your profit target, you have a free contract in, and you're in the run, why in the world would we ever lift that off? But I've heard it from a few traders where it reaches a certain point of profit, and then they're okay. That's good enough for them. But, I mean, really, if we think about it, after the close of bar 18, even if I'm trailing at the high of this bar, I mean, why would I lift it off? What's going to happen if I get stopped out? I'm going to this next bar is plotting. It's in the middle, and it's 3 ticks higher or 6 ticks higher than what my stop is at. Why would I lift it off? The worst thing that's going to happen is it's going to come hit my stop, and I don't get those 3 ticks. I'm willing to risk the rest of a run over 3 hypothetical ticks that I don't have yet. I don't think it's a great idea. So, because I'm telling you, if someone does that, and then you jump out because you're okay with $200 or $300, whatever it is, and then you see the run go on like this, you're going to be kicking yourself. So, little into some tips that can help you combat that fear and greed that is probably one of the hardest things to train yourself to get over. But it, of course, can be done. And I think one of the things I see that distinguishes someone who is extremely successful with this system is discipline and following the rules and sticking to your trading plan, especially over time. As I feel it's pretty common when something doesn't work out or it's a bad day, really choppy market or something like that, and it's just not working out. Of course, we want to say, what's wrong? It's not working anymore. And, those things are going to happen. There's going to be really choppy days. There's going to be days where there's no trades, or there might be one trade and it happens to go against us. I mean, all these type of things are possible. So we have to be prepared for that and really look at it as a strategy for gains over time. That's where it really shines. Because even despite any losing days over the course of any given month, does end up profitable. All right, everyone, we're about 8 minutes from the end of today's session, so I do want to make sure if you guys have any questions or would like to cover anything else before we go for the day, please throw those questions at me. If you don't get to them, you can feel free to send me an email at support@academydaytrading.com and we'll get to you as quickly as possible. Or save it for tomorrow's class, where we'll try to find a dot trend trade, which are probably the most uncommon trade, but we'll see if we can dig one up. I'll also cover choppy market conditions, so we can be prepared for that. Know how to avoid some situations where it's just not an ideal time to trade. Just because there's movement in the market doesn't mean that it's a good time to trade, as our strategies are, most of them are trend trades. We do have the divergence reversal, which is counter trend. So we're looking for clear trends. And if the market is indecisive or choppy, we're not going to find any good setups. And we could end up getting stung quite a bit if we keep in that mindset of, I'm trying to get into all these trades, especially after I've taken a loss, and I need to make up for that loser right away. And then it can just cloud your judgment and cause additional problems. So we really want to, just stay calm, cool, collected, wait patiently for the best setups is what we want to do. So I want to stress that to everyone, and we don't want to be looking or digging for trades, because I'm sure everyone's heard the saying, if you look for trouble, you're going to find it. Same with trades. If you're really looking for a trade setup, you can convince yourself that there's a trade setup there. And it may not be the most ideal trade setup. So something I do like to try to stress with this system, on average, you may see 8 to 10 trades on a given market during a day with normal movement. So if you go back to the debriefs, you often see it's right around that number, sometimes a little more, sometimes less on slow days. On extremely abnormal days, it may get above 25, 50, and that's usually when the market's moving really fast, and it's hard to catch a lot of those trades anyhow. But with practice, really learning how to anticipate the setups, you can catch a good portion of those on those crazy market days. All right, everyone. Let's see. No final questions. Is there anything left to cover? I'll leave the questions box up for a few minutes in case anyone hops in or has a question before we sign off. I'll go ahead and close the webinar in about 4 minutes. I'm going to go ahead and sign off for the day, so I don't really want to get started on another example right before we're done. So I hope the rest of everyone's day goes well. Your trading day today and tomorrow goes well. May the EMAs always be at your back, and happy trading.